You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, me and my family made the trip up to northern Wisconsin to visit the folks. This is where I grew up, and I'm really happy to be from Wisconsin, but I'm also very happy that I have left Wisconsin. Overnight, it is going to be approximately 15 below. So that's what we're looking for, the low going into the holidays. But it is a white Christmas, so we got to emphasize the positive. So with that said, I'm doing this, I'm taping Options Playbook Radio from the basement of my in-laws' house. And I think that's a perfect time to talk about a stock like Tesla. Because as far as Tesla is concerned, I'm very confused that the powers that be would think that everybody in the world would want Tesla in their retirement accounts. And how does that reference work out? Well, it just went into the S&P 500 index this week. And when you think about that, that means that all of these index funds are going to be forced to buy Tesla, to put them inside their funds. It's a stock that is probably the hardest to borrow stock on the planet. It probably has been shorted more times than companies that have gone bankrupt. And yet our wise people at the S&P 500 index decided that this is the stock we should be putting into everybody's retirement account. All right, so with that said, we're going to look at Tesla. Mark Longo actually informed me today before the show that Tesla is now one of the leaders in open interest. It's basically everybody in the planet is trading options on it right now. So I guess we might as well join in. And what we're going to do, it's trading at about 50% implied volatility, which is actually the lowest that it's been in quite a while. And we happen to be on a short week. So we are taping Options Playbook Radio Wednesday, December 23rd. The markets are open and the markets are rocking. We got the markets up a little bit today. The S&P 500 index is. Tesla right now is trading, and I'm going to round off because it's a live quote. It's trading at $644, up about 3.5% today, or about 0.5%. So we're going to do a very short-term trade. We're going to bet that Tesla has more volatility as opposed to less volatility. So it's a very speculative trade. And as always on Options Playbook Radio, this is not meant to be a recommendation. We're just going to look at this trade and see how it plays out. Tesla options are very interesting in that we have an expensive underlying, $640, we'll call it $644, I guess. Like I said, we'll round off. and it's trading at a 50% implied volatility. And in my mind, that should be 100% implied volatility on these option contracts, but it's at a 50% implied volatility. We got 1 day remaining until that expiration date. So we're going to look at doing a ratio spread to the downside. We've already had a couple of big down days in Tesla since it's been announced, but that's mainly because of the, buy the rumor, sell the news scenario where they had a huge run up going into the fact that it was going to be placed in the S&P 500 index, so had a strong move to the upside. And then once it came into the index, a lot of people anticipated, you're not always 100% right, that it would actually sell off and start coming down. And that has happened at this point in time. So we're going to stick with that trend. We're going to do something that's going to benefit if we do get a big push to the downside. And then also it will not hurt us if it actually goes to the upside. And so how do we pull that off? Well, that's called a back spread. And we're going to do it with puts. If we're going to be a little bit lean to the bear side, we're going to do it with puts. If you're leaning to the bull side, you'd be doing it with calls. It's also known as a ratio spread. Another name that we call it inside the options playbook is a pay later put. And I'll explain that concept. I actually like the name a pay later put better than calling it a ratio spread. And I'll explain that as soon as we get the strategy all set up here. So we're going to be looking for a 15-point move in either direction. The underlying stock says that is feasible. If I look at the at-the-money long put and the at-the-money long call, that means that underlying right now, that long straddle is trading for just north of $15. So we are going to be selling the 660 call, and that's trading for around $18.50. And we're going to use that premium to buy 2 of the at-the-money calls. And those are trading for around $8 and we'll call it 20 cents. The market is moving quite fast. So when we do this entire trade, we're going to do this for a net credit to the account of $2.20. So if we do it, we're saying that we're expecting by 1 o'clock tomorrow that Tesla will move in either direction the width of the spread. That if we don't think it can do that, then we're not going to do this trade. So the width of the spread is 15 points. So we had 2 days of it making that type of move after the announcement of it being in the index. We have the rest of the trading day today, and then we have until 1 o'clock tomorrow. That's when the markets will close, and then the markets will be closed on Christmas Day all day long. So we're going to be doing the December 24th expiration date, and we're going to be doing this entire trade right now, and I'm going to put it in the paper trading rail for a net credit of $2.10 to the account. Now, what we're doing when we do a ratio spread, and hence the name pay later put, is that we're actually selling a credit spread to pay for the additional put. So if we look at the trade overall, we are selling the 660 put and buying one of the 645 puts, and that credit is then used to pay for an additional 645 put. So hence the name pay later put. Part of the reason why we are doing this trade this way in that if we are incorrect in our forecast, we aren't paying for it right now. If that underlying stock just stays right at 645, right now it's at 644, but if it stops right at 65 at expiration, well, in that instance, we could lose the maximum, which would be 15 points minus the net credit received, or $2.10, or a total of $12.90 for every 1/2 ratio spread that we put on. So that's our worst case scenario, and that's very hard to have happen. And that means that we went all the way to the expiration date. The stock stayed at 645, and just all the time premium came out and it expired. Now, if I look at this underlying, what would we like to happen? Well, if the underlying stock goes up 15 points, guess what? We're going to be out of the money if it goes beyond 660, and we're going to receive that net credit to the account. And that net credit is nothing to sneeze at. It's $2.20, so it's a decent amount. But if it finishes above 660, all the options expire worthless, and we get to keep that net credit in the account. Now, the best case scenario is that it goes down, and it's better that it goes down in a hurry sooner rather than later. So if it goes down, we're long one more put than we are short. So from 645, we'd ideally like it to go down below or move at least the 15 points to the downside. So from 645, we'd like it to go down to 630. The quicker it does, the better we are, because we are long to option contracts and we want to sell those underlying option contracts while they still have time premium in them. So that's the concept, and hence the name Pay Later Put, because we're bringing in a net credit. But if we are incorrect on our forecast and it stops right at 645, we would pay later for that put option contract overall. So if you think that Tesla has more volatile days, well, a day in it, because this is a very short-term trade, we got to get it done before the holidays, right? We don't want to be thinking about this over Christmas, so we need to get this trade done as soon as possible. I'll give you one quick summary on it, and then we'll just move on to the holidays, till Christmas, I guess. So here's the summary. We're doing a back spread in Tesla. We have Tesla trading right now at 644. It's up about 0.5% today. We're going to do the December 24th expiration. Thursday, the market stopped trading at 1 p.m. So this is going to go to 1 p.m. on Thursday. We're going to sell one in the money put, the 660 strike put, and use the proceeds to buy two at the money puts, the 645 puts. We're going to do this for a net credit. Actually, right now, it's a net credit of $2.50 to the account. Our max risk would be the width of the spread, 15 points, minus that $2.50, or $12.50 overall. We have unlimited upside potential if the market does go down. If the market does go up, the maximum we could make is that $2.50 net credit to the account. All right, well, that's going to be it for this episode of Options Playbook Radio. My name is Brian Overby. You can email me at theoptionsguy@invest.ally.com. And thanks for listening. Until the next time, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.